over the course of the last couple of months, both in Rainmaker and Entrepreneur. And let me take you through some of that thinking, what we've been up to, and how we're currently positioned. So, Dave, if I can ask you to all of you to turn to slide 2, I thought I'd just start with, just some perspective on the evolution of the domestic South African equity market. If you look back, this is just the all-share index as one of the benchmarks that you may be using. There's quite a variety of these things now. They all have their own peculiarities around their particular heavy components, whether it's Naspers or Richemont or BHP Billiton. But you can see, as I think you all know, the domestic market has been a very tough time a very tough place for South African investors and South African savers for quite a considerable period. What I'm showing there is the red line is at 50,000 for the all-share index, which you can see we first got to way back in 2014, 6 years ago now. We've essentially, as I think many of you know, been pretty much just going sideways for a very long period of time at best. And within that, there have been substantial deviations on a stock level and a sector level. But really, overall, the market going sideways. And then in sort of early to mid-February, the market got back down to that 50,000 level, which has been a fairly solid level of support. We then experienced the sell-off as the full impact of COVID-19 became apparent to the investment markets once it spread beyond China, and we were seeing it escalate, cases escalating very rapidly across Western Europe into the United States and now in practically every country in the entire world. But you'll also notice, so from the peak, from the beginning of the year to the trough, our market dropped 30%. But interesting to note how far it has recovered, relatively speaking. So I did these charts on Thursday last week, so they are right up to date. And you can see how far the market has bounced off that very low point. If we turn to slide 3, back in February, when the market got down to that 50,000 level, we were sort of making the point that relative to history, although our growth prospects continued to look pretty poor, this is even prior to taking anything related to COVID-19 into perspective. This is a message we've communicated on a very consistent basis that unfortunately the domestic operating environment and economic environment was very weak and not conducive to being able to generate any kind of growth from our domestic businesses, whether that was retail-oriented businesses, the banking sector, domestic manufacturing certainly has been in the doldrums for a long time. And we weren't seeing, although we were seeing a couple of glimmers of hope in a few isolated areas. Sanral, for example, was actually starting to spend a little bit more, having been practically absent for the last 3 years. But it was very isolated, and largely, prospects for growth continued to look pretty poor, although valuations were starting to look very attractive. So that's what I'm trying to show on slide 3, is that if you looked at the top 100 stocks, excluding Naspers, the PE ratio was back down into relatively inexpensive territory. Arguably, it should be there because the growth prospects are very poor, but certainly we were not worried about our market being overly expensive. If we move on to slide 4, I just wanted to show you here the massive dispersions in returns. So it's quite a busy chart, but I really just, what I'm trying to show you is how much domestic South Africa has underperformed, and that you really wanted a portfolio that's had very limited exposure to the domestic stocks. So the little white line in the middle is the all-share index, and it takes you back. This is to January of 2019. So what's that? About 16 months ago, and you can see, just highlighting the events of the toughest part of the COVID-19 shock to the system. What you can see starting at the bottom is, the weakest example is Sasol, which is down 85%. You can see from where we were in January of last year. You can see the all-share index is down 5% over this period. This is capital appreciation only. You can see our general retailers. The general retail index is down 54%, which is the brown line, and then the pink line shows you our banks index, which is down 45%. So those two combine quite big components of the market, quite big, representations of our domestic prospects for domestic-oriented businesses. Many of them have a little bit of offshore, but largely they are South African businesses. And in contrast, you can see above the white line what's pulled the market up. It's essentially only been three things: Naspers, and you could add in Process, which would look very similar. British American Tobacco, which are both up more than 50%. The platinum stocks, which have been very volatile, incredibly volatile, in fact, which I haven't put on here. And you can see gold is up at 240%. So, if your domestic portfolios haven't had exposure to those three, and you've had too much of the other, you can see that's, you've had a very, very poor year. And if you've had those three things, you've had a very good year. Rainmaker, I'm pleased to say, has, its largest positions, and in fact, today a third of the portfolio is in Naspers, Process, British American Tobacco, and Reinet. The combined weighting of those four stocks, or essentially really only 2.5 stocks, makes up a third of our portfolio. We've done really well out of them, and gold is another 4%. So we're under, relative to the all-share index, we're underweight gold, but we do have a very healthy position. And certainly the biggest position in direct gold shares that we've owned in, I would say, 8 or 9 years. So those have really helped. But unfortunately, we have had a bit of Sasol. We've got banks, and I'll talk you through that in a second. But we have very limited exposure to retail, and to the extent that we do, it's via pretty defensive positions. SPAR is one of I think our biggest retail position in the portfolio at about 1.5% of the fund. So moving on to slide 5. So what have we been doing at ABAX over the course of the last quarter? Well, the first thing is the early analysis of the situation was it looked like another SARS epidemic. I don't know if you recall that event of about a decade ago. We've also seen subsequent breakouts of avian flu in various parts of the world, and though none of those have had particular long-lasting or dramatic effects on market prices, global activity in trade and commodity demand. And the early indications were that it was just another strain of those exact type of afflictions, and that the mortality rates were substantially lower than that of what were recorded under SARS. And so, was this a buying opportunity, that there was a bit of an overreaction to something that really wasn't that serious? So we didn't think that was the case. We were particularly reminded of mistakes we made at the time of the global financial crisis in 2008 and 2009, where what at first appeared to be a simple case of mispriced credit product in the United States, and where a few people who had been sold a parcel product where the label on the outside said that it was AAA, but in reality it was junk. Was a mistake that was going to be made by a few American savers and institutions, and the rest of the world would carry on regardless. What happened quite quickly, though, we realized was that these instruments had been sold globally, and there was practically not a retirement fund in the world that escaped unscathed. And we saw the tremendous impact that the global financial crisis had when banks and credit lending and all trade essentially came to a grinding halt within a very short period. So learning from those lessons, we acted here very aggressively, while at the same time, monitoring just how long-lasting this impact was likely to be, particularly in the context of how aggressively monetary and fiscal authorities have reacted around the world, especially in the largest economies, obviously China and America being the two biggest, but then elsewhere in the world. And what we've seen is an extremely aggressive response, economic response to the COVID-19 crisis from a monetary and fiscal perspective. Arguably, there are less bullets in the chamber that can be fired, or the base is lower now than it was in 2008, 2009. But the extent of the stimulus that has been applied is much greater in absolute terms. In fact, in the US, it's double what was done in 2008, 2009, and has happened much faster. And so one doesn't want to overreact to a situation where the extent of the decline is going to be substantially mitigated given the degree of stimulus that's been applied. These are questions that we're still wrestling with every day, but we do need to focus on what we do know, and the degree of stimulus that's been applied has been extraordinary. Is a very insufficient word to describe what has been done. Our focus, in addition, has been on the financial health of every single one of our underlying businesses. Not that that isn't part of our ongoing investment work, but certainly we've wanted to move quickly against businesses, or have done a lot of extra work on any holdings that we've got where there are the debt levels in those businesses, for whatever reason, is relatively more elevated at the moment, and where their cash flow may come under any form of pressure as a result of contracting activity. In South Africa, we're getting used to the new normal of a substantially weaker rand, higher bond yields, and the possibility of rising inflation in the future. So how has that translated into activity in the portfolio? We have maintained a very substantial rand hedge component to the fund, unless the underlying prospects for those businesses we have felt have been diminishing and getting weaker. So what you have seen is we have continued to hold very substantial positions in Naspers, Prosus, British American Tobacco, and we bought more Rainmaker. In contrast, however, we have become, much more concerned about the degree of the impact that the COVID-19 will have on the profits of Richemont, AB InBev, Bidcorp, and Mondi. Despite the fact that all four of those are high-quality businesses, in most cases extremely well run, or have, with the exception of AB InBev, Richemont, Bidcorp, and Mondi, their balance sheets are in extremely good condition. AB InBev less so, still battling with the the digestion of the SAB Miller deal, which is now 6 years ago. So we've sold out the Richemont completely, substantially reduced AB InBev. We've sold out Bidcorp completely and substantially reduced Mondi. On the domestic South African side of things, we've looked to rotate into more defensive holdings. So we've sold out Barlow's, Motus, Imperial, Truworths. Particularly unhappy about the recent corporate action at Barlow's, Barlow World. We've also spent a lot of time looking to see where there has been wholesale, selling of stocks in particular areas, whether it offered an opportunity to increase our exposure to high quality businesses that have been indiscriminately hit, and that we think are holdings of businesses that we've really liked, and that we've never been able to get our heads around in terms of the valuation of those businesses. So good examples that you might think of here would be a business like Clicks. You can see with their results last week, that rating, which we felt is just, astronomical, outstanding business, but astronomically high rating, did take a big hit, but we know it's still not even close to what we would consider as attractively priced. But a business like AVI, which has been a holding in Rainmaker and is a high quality business, we think that will weather the storm extremely well, and which has fairly limited exposure to very discretionary side of their portfolio. We've added to that. Another good example would be businesses like Famous Brands or City Lodge, which are down sort of 80 in some cases, in both of their cases, I think more than 80%. We're doing a lot of work there at the moment. I think it's a little bit early to call, and they are outstanding businesses, but we think both of them have got a very tough time for the foreseeable future, because they're obviously going to be quite late on the recovery phase, but looking a lot more attractive than they have done for many years. We've also looked to rotate into things that are more defensive. So both in Rainmaker, and you'll know, for those of you who invested in Entrepreneur, Santam has been an outstanding business for a very long time. Is one of I think it's the single largest holding in Entrepreneur. Yes, it is. And we bought some in Rainmaker and across our equity funds. We think this is a business that's extremely well structured to weather the storms and the waves of COVID-19. We increased our weighting at Spar, Rainet, and we used the weakness in BHP to add to that, where the incredible how resilient the iron ore price has been through this period. And we also added to Anglo Gold. And we've nibbled a bit of ABSA in addition. I'm going to come back to the banks because I think that's the thing. That's the part of the portfolio I'm worried most about at the moment. If we move on, then let's do that to slide 6. This is slide 7. This is the bit that probably worries me the most. So we have got a healthy degree of skepticism about the long-term attractiveness of banks. For many years, our preferred exposure to the sector has been through FirstRand, which is a very high-quality business, and has been the relative winner. We've owned a bit of Capitec. That's another whole story on its own we could spend 10 minutes on, and we have been trading that one. It's offered wonderful opportunity literally in one day to get a lot done, which we did manage to get a lot done in mid-March. But it's a much smaller position in the portfolio. As I was saying, FirstRand has been our preferred exposure to the sector, But the South African banks have continued to be derated and derated and derated by the market. And you can see that these charts were the ones we were talking to clients about back in February of this year, before any of the COVID-19 real issues had hit the world. And you can see the South African banks price to book, that the first chart in the top left-hand side there is the South African banks relative to emerging market banks on a relative price to book basis, had derated to the lowest point they'd been at in the last 6 or 7 years. So that got our attention. If you looked at the absolute PE, you can see that's on the top right. So the PEs for the sector had come, right down below 10 times. Obviously, there's a bit of a divergence within this because First Rand is at a bit of a premium, and you've got Standard Bank, and then below that you've had ABSA and Nedbank. And the dividend yields were very attractive. So even though we had very, very sanguine, I would say, expectations around growth prospects, about profit growth. In February, we were expecting low growth and in profits and low growth in dividends. When I say low, I mean sort of low to mid-single digits year on year. But considering how attractively they were priced relative to their history, we had started to accumulate. We continued to hold our First Rand. We also had built a position in Standard Bank going back about a year or two to when we felt that business was finally through the worst of its problems with respect to a very costly technology refresh at the business. And we were hoping that their problematic business in London, now that they'd reduced their equity position in it, would become less problematic. And it was trading at a very big discount. So we had built a position in Standard Bank. But then we also started to build a position relatively small in ABSA and Nedbank, which were trading at substantially lower valuations relative. So that was back in February, and I think we had probably a combined banks exposure in February of about 13% of the portfolio. And then along came COVID-19, which has it's materially derated the businesses again. And if you turn to slide 8, you can see that reflected here, including the hit of March. They've barely bounced off their lows. I mean, they've all gone ex-div. So despite the Prudential Authority saying they would want banks to be very careful about paying dividends from this point on, they had already declared dividends for the period to the end of December, and have subsequently paid all of those dividends out because the guidance came after the dividends had already been declared. What happens between now and the next time that they have to consider these decisions, which is 6 months out from now, remains to be seen. But as you can see, for many businesses, dividend decisions are being deferred in favor of accumulating cash to weather these uncertainties of the environment that we're in, whether you're a bank or an industrial company or anything else. And we fully support that conservative stance for the time being. But it won't last forever. And in the meantime, Nedbank got down to a P of 3 times at one stage. So we've never seen valuations like this, even as illustrated in the chart on the left at the trough of the global financial crisis. And so valuations are tremendously attractive. So you would have to ask yourself, well, as we do, it doesn't matter how attractive something is. If it's going bust, why would you want to own any of it? And so I think the next charts, the next thing you need to do is ask yourself a few questions about, how long you think the event is going to last, how great an impact it's likely to have on bad debts at the banks, how they will manage in partnership with all of their clients through this process, and how much worse or less bad an event is it likely to be when we emerge out the other side in comparison to the global financial crisis. And you will all recall how relatively well the South African banking sector managed to steer its way through those events. We have already seen a very constructive intervention from the regulators around softening their stance on loan loss accounting. This is a technical issue, which I won't bore you with, but if anybody wants to go into the detail, please contact me directly, after this, and I'll take you through that around recognition of underperforming loans under a new accounting standard. So that's been deferred, and the regulator has also offered the sector additional flexibility with respect to liquidity and capital buffers, which is a very constructive stance to have taken. In addition to that, we've also had substantial interest rate cuts, which for businesses that have borrowings will make their existence a little bit easier under the circumstances the world finds itself under. The next important thing to look at is on slide 10, is to show you that the capital positions of all of these banks is substantially better than it was in 2008. And you can see that on slide 10, that shows the CET1 ratios and the movements for the four major banks in South Africa. And you can see that the level of capital provisioning is substantially higher today than it was when the 2008 crisis hit. So the bank's balance sheets are in a better position to weather the storm than they were in 2008. And that's principally the other point to make is that when we went into it in 2008, it was at the end of a protracted boom period in South Africa. Very strong period between 2003 and 2008 of consumer growth, of the explosion of the unsecured credit market. There was an explosion in mortgage lending activity when property values were increasing very quickly. We haven't had anything like that. And in fact, in the last 10 years, despite low inflation, anemic growth, relatively low interest rates, credit demand growth in South Africa has been extremely low. So it's averaged about 4 or 4.5% for the last 10 years. So we don't go into this event with highly indebted, on average, consumers and businesses in South Africa, because demand for credit, given our very unexciting economic growth, has been low. So the balance sheets on average, of course, there will be exceptions, and this isn't a severe event that we are going through, but the banking sector and its clients go into it in a relatively better position than they were going into the 2008 crisis. And of course, as we pointed out before, and I'm reminding you on slide 11 there, is that the valuation levels are unprecedented in history. So, while we are nervous, we continue to hold a fairly large exposure to the sector. In fact, we own all of the major banks that are, I would say, it's the area that we are definitely spending the most time and effort and focus on, and you could expect us to be reasonably nimble around how we're adjusting that portion of the portfolio. At the same time, we're not reducing our, despite the substantial weakness in the rand in the short term, we are not reducing our exposure to our major rand hedges, principally because we believe the valuation of those underlying businesses in their home currencies remains reasonably attractive. And of course, in the case of Naspers, we have the double whammy of the discount structure, which allows us to buy 10 cents at half price, effectively. Okay, so that's, if I can move on then, make a few comments on Entrepreneur specifically. Really just a very similar thinking and the style and approach that you know and are familiar with in Rainmaker, but obviously with a few specific nuances. So Entrepreneur has had we have long-term investors here. So Entrepreneur's performance over the last couple of years has been, well, relative to its benchmark indices, has been most satisfactory. Relative to the peer group, has been mediocre, but we've had a very, very strong relative trot in the last month or two, and I would say it's our conservative stance that's been vindicated in this regard. Our super defensives in short-term insurance, I've already spoken about sometime, but we have a big position in RMI, essentially outsurance. Together, those are 10% of the portfolio. We have much more limited opportunity for rand hedges given the mandate limitation, but have retained big positions in Naspers, British American Tobacco, Rainet, Oceania Fishing, which is a business that's just perfectly positioned to all of the circumstances we're finding ourselves in. It's really barely affecting them, and of course a lower oil price for a fishing business is really good news. We have limited mining and have traded the platinums that are available to us very aggressively. We have already had 2 corporate actions in the last 2 months around takeouts of businesses that we thought were pretty undervalued. The 2 on the list are Assor and Peregrine. We've got another couple of interesting things in the portfolio that I think we could get similar approaches on, and that clearly shows that even in these tricky times, that there are astute people out there who, if they see value and are able to access capital, that we could see future strikes. On that, I spoke earlier about our focus on balance sheet quality and the opportunity to acquire quality businesses at a discount. So I talked a little about AVI. We've added here in Entrepreneur as well. Adcock Ingram is also over 4% weighting in the fund. Obviously a very defensive business. I expect sales of Carenza C and Panado will be at record levels, and very limited impact on a business like that in the circumstances we find ourselves in. We have looked to limit discretionary domestic consumer exposure as far as possible, and have even sold down out of the limited ones that we do have. We had a few Truworths. Italtile is an outstanding business, and one that has been a long-term holding in the portfolio. Reluctantly, however, we have reduced the weighting because I do worry that they're going to see an impact for some time around the volumes that they were selling, and we've rotated that more into the more defensive Pick and Pay. I talked about Barlow's in Rainmaker already, which we sold out. We sold it out of Entrepreneur 2. We do have positions in CMH, Udeka, and Roynett, which are domestic vehicle retail, domestic manufacturing activity and electrification. A little bit of brand hedge in Roynett, but limited. They are cumulatively probably 8% of the portfolio. I do worry a little bit about those, but they're all trading on PEs of less than 5 times. From a flow perspective, it's been very steady. Rainmaker has been very quiet. Entrepreneur, a little bit more activity. We did have sales from 2 clients who had historically been very supportive of the fund, but in total it was 100 million rand, and we've been able to manage that very easily. So nothing from a flow perspective that we're seeing that's causing any difficulty in the management of either portfolio. If we move on to slide 13, there's just a little bit of marketing material just to show you how Entrepreneur has managed to weather the storm that we've been under relative to its two primary indices. Obviously, no one likes to be showing negative numbers, but I'm very pleased that our defensive positioning has been able to protect, being relatively effective at limiting the downside, and also we would look, in a little bit of recovery that we haven't given any of that up, and looking to remain nimble in order to use this market opportunity to add value relative to what's available. So I think I hope that's just some perspective and thoughts on how we see things, what we've been up to in both portfolios. I hope you've all had an opportunity to read the quarterly commentaries, where I think we deal with some of these issues, but hopefully this adds some additional perspective to those. And as always, you know where to find us. We're not going anywhere, and I'm happy to take whatever questions you have now.
Thanks very much for that, Ant. And thanks, of course, for taking us through the SA banks at such length. I think given the structural significance of the sector to the economy, and or for the country for that matter, it's much appreciated. And then, of course, regarding the Entrepreneur, I think those clients with allocations to the small and mid-cap space will be happy, I guess, with the relative performance of the fund, as that current slide does show. We have a handful of questions. Unfortunately, I think in the interest of time, I'll ask the one that looks most interesting to me, if you could just maybe give us a quick response. And it's with regard to the opening up of economy. So the question is, with China opening up, and I guess the rhetoric coming out of Europe and America is they're going to be looking to do the same quite soon. Do companies such as Richmond and Bidcorp start looking a little bit more attractive at this stage?
So again, this is it's a good question, because you have to try and gauge, how quickly this can happen. Does it all snap back and it goes back to life as usual, or are we in for a more difficult stop-start type thing where consumer behavior proceeds to recover, but on a gradual basis because people are nervous? We don't know the answer to all of these questions. What we do know, though, is the valuations for both Richemont and Bidcorp are still very high. That's the first point. The second point is, I think both businesses are going to be affected for a protracted period. I don't think anywhere in the world, and you read conflicting things. We saw, for example, last week, one of the luxury goods businesses, LVMH, came out, or Hermes had opened a store that was up 50%. But is it 50% on the week before? Is it the same week of the prior year? Was the store there the prior year? So people, you have to be very careful about the source of the information and the accuracy of what is being communicated, and we're not going to be responding to any headline perspective that you read. What we do expect is that consumer behavior is not just going to snap back, and that people will proceed very, very carefully. And we also think that the last parts of the world that are going to recover back to normality will be ones where there are mass gatherings of people who are coming together into enclosed environments, and where the people that are gathering have come from a possibly geographically very dispersed origin. So that's obviously sports events, concerts, but equally so restaurants, hotels, airports. So we're expecting a very gradual recovery over a protracted period of time for businesses exposed in that space. Now that's right in Bidcorp's. That's exactly where Bidcorp stands as a supplier of food services to restaurants, hotels, bars, catering companies. There's going to be a little bit of work that's done around out of home and clever things like that, which will help to offset it, and we might see home delivery services, suddenly flourishing. But broadly speaking, consumer activity we expect to be suppressed. And equally so, top-end luxury goods, which is where Richemont is at the top end, combined with Richemont's problems with respect to its so far disastrous, or not disastrous, but disappointing investment into the online business where it took out the minorities a couple of years ago, combined with the existing rating of both of those companies, is keeping us out for the time being. I'm very comfortable with that decision, both of those decisions.
Okay, thanks very much for that. And unfortunately, we do have to finish the call at this point. So yeah, and from myself and the team here, thanks again for taking the time out of your morning today.
Well, David, if there are any follow-ups on anything that anybody wants to ask urgently, you're welcome to mail me or give me a shout. I'm happy to answer those. So thanks for your support. Hope you're all keeping safe. We're a long way before we're out of this, guys. So look forward to seeing you all face to face again one of these days. And thanks for the ongoing support.
Indeed, thanks. And to echo what you said, if there are any questions on the back of today's presentation, please do get in touch with your Nedgroup representative, and we'll pass that along to Ant and get you in touch with him. So thanks to you all for joining us from your homes across the country today. I'm sure you found Ant's views as insightful as always. A reminder that this call, along with previous ones, has been recorded and are available, so please do get in touch with your Nedgroup Investments relationship manager should you wish to receive these. It is a shortened week this week, so please join us tomorrow when we have Ian Anderson chatting about the Nedgroup Investments Property Fund. And finally on Thursday, Yanni Leach will be providing feedback on the Nedgroup Investments core range. So from myself, thanks again, take care, and enjoy your shortened week ahead. Thank you.